Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The Bloomberg Dollar Index is at the highs of the year so far. Euro dollar is 107. You have, yes, the euro is a little bit stronger against the dollar, but man, it was a really tough week over the last week with the turmoil in French politics. Luckily, we have an expert with us. Marcus Ashworth is joining us. He is from Bloomberg Opinion. I haven't talked to you, Marcus, in, I don't know, 10 months?
Yeah, it's been ages. Too long.
Too long. It is so good to hear your voice. Okay, what we love about you is because you have opinions. What do you make of what's unfolding in France right now?
I'm such a shy, retiring type normally. What do I make of it? I mean, look, it's not a crisis yet, anyway. I think it's a problem which was 3 years out in the future in 27, whoever's going to replace Macron. He's just rolled the dice and brought it forward by 3 years. He's trying to solve probably a bigger problem now, earlier, and getting a better result, perhaps, he hopes. What it has highlighted is that there's been a long, deep-seated, ever-growing fiscal problem in France where they've hidden, essentially. They've been allowed to get away with it for ages and ages. First, we had a Fitch downgrade in October. We got a S&P downgrade in the end of May. And we got Moody's now having a sort of little think about, really, do they genuinely think France is worth a AA2? So that's because the fiscal deficit in France has risen to 5.5% of GDP, and more importantly, its debt to GDP is started rising again. There had been great hope of this downward glide path for both France and Italy. That's not happening. Didn't happen at all last year. Went quite the other way, and doesn't look like it's going to get better for at least out to this 2027 period. So no one thinks that even the current situation would have seen any fiscal improvement, with potential of a non-Macron sort of controlled prime minister and government. That means that quite the reverse is going to get even worse, and that isn't great news for France, isn't great news for the European Union. They hate political volatility. They get very spooky, particularly of a potentially Eurosceptic or pro-leaving the European Union as it once were party might get into some form of power. They get very antsy. So that's why you're best to sell or get out or stay out of France until it settles down. July 7th, we'll get the second round final results for the parliamentary elections. Macron's staying around for another 3 years.
I love the whole snap election thing. I like, because we're over here in the U.S. We're going month after month.
Oh my God,
after
years
month,
and years.
just to get to November. Yes. So I kind of like this whole snap election thing here. But what's behind, Marcus, do you think, the rise of Marine Le Pen and the far right? Is it what we're seeing just around the world? Is it political? Is it economical? What's kind of really driving it?
I mean, I don't think you can call her far right. To my mind, she's a socialist. She's pretty hard left.
Okay.
And other than the fact that she's a national so-called champion, and that's what she wants to push. French pension rights, French welfare rights. She's very pro-union. So in some senses, I know it's easy to label them far right, but the point here is that what clearly she's standing for is a sense of enough already from the French people on mass immigration.
Yep.
This is happening in Italy. This is definitely happening in the UK. It's happening everywhere in Europe, and I know it's happening in the US. So look, this is a global problem. It isn't going to get solved anytime soon, but you're going to get. Look what's happening in the UK. We're getting Rishi Sunak going to get bounced out because he's failed to live up to anything he said he would do. But we're having similar across the European elections where results tended to favor the more, should we say, anti-immigration parties. Whether some of them are left or right is a subjective point. But look, this is just bad fiscal situations getting worse, combined with that awful thing that European politics really doesn't like is that fear that the European Union, the Euro project, might come under question. And that's when investors, which you believe very much in this whole France-German bedrock, and everything's been calmed down. We've got the EU issuing bonds by the gazillion in the middle, lots of pandemic programs, spraying money everywhere. And yet, it isn't enough. And that's a little bit of a worry. I see it as a little reality check, and maybe in the long run, this might be better for Europe if they can get their act together. I don't see it as a proper Euro crisis or anything like it.
Have you noticed, or are you hearing flows coming out of Europe into the U.S. because of the political issues there? I mean, we have our own mess, but what we do have is NVIDIA.
Alix, you've got it all already. What more do you want? You can't want more of our money.
Yes, I do. I want all of your money.
Everyone in Europe is already overweight in the US. Look, I mean, I would say it's more likely to be US investors who might have been tempted to get out of the US and diversify at long last, coming up to Euro elections, may have been tempted to sort of go into Europe and have a little sniff, particularly around banks and things like that. That's why the worst performers so far have been French banks. They've been absolutely spanked. The reason why they've been spanked is because I think there's a very popular situation for US investors looking to play the old rebound there. And that, I think, is what we've seen. We've seen some fast money exit stage left. I don't think European investors are going to go anywhere. I think Japanese had already long thought very carefully about the so-called Bund Plus strategy, where you bought French bonds, you were locked in, like with Germany, you got an extra bit of yield. That works a few years ago, not so much anymore. But yeah, there may be a little bit. And so all I was saying is I just don't think any new money is going to come in until July the 7th. Why would it? It's crazy to take more risks than you need to when you've got no visibility on the outcome. There's likely to be one or two more bumps in the road before we have a clear idea. The way the French system works, you have this first round on June the 30th, and then and only then you get a clarity of who goes forward into the second round, and you can work out which personalities are going to be doing probably better or worse with more accurate polling. But that will come clearer as the days go by. I note that this afternoon, actually, France is starting to do a little bit better against Germany. French yields have actually gone nowhere in the last week and a bit. It's just that German yields have fallen hard because they're following, yes, you got it, Alix, they're following the US yields lower. It's all about the US.
See, told you.
Hey, Marcus, it was just a few weeks ago when Mr. Macron hosted a basically come back to France conference where David Solomon, Goldman Sachs was there, and Mr. Moynihan from Bank of America. I mean, is France open for business? Are people investing in France?
They still mark the spot. This is where Jamie Dimon stood. Now, look, we have a little competition. Funny enough, the first thing that a Labour government, almost certain in the UK, are going to do is to do exactly this. Come to the UK, everything's brilliant. Come back to do business. So Macron's been very good at this, and definitely there's been some signs that not so much that the city's losing jobs, but that France is attracting more financial jobs. It's quite great tax breaks to go there. At the same time, clearly they want to promote all foreign direct investment, and arguably financial big movers, Citadel, JP Morgan, Bank of America, etc., are responding a little bit to the challenge. And one interesting thing is I think that Macron is going to relax a bit on how much that severance pay has to be in France, which is one of the big things that banks don't like, is the cost of actually losing people when they change their minds on their expansion plans. But for the moment, yeah, I think they've done a good job in France, and probably outside of London, Paris is the logical place for most financial companies and banks in particular to go. But again, they don't need this sort of publicity. It's not very good for them.
Marcus, always a pleasure. It was so good to chat with you. Definitely miss all your commentary. Marcus Ashworth of Bloomberg Opinion. I have to say, at my Father's Day dinner last night, for some reason, doing business in France came up in the conversation and about unions. And I was like, what does this mean? Like, are we at peak union? Like, what is the significance of regular people on the Upper West Side talking about this?
Yeah, I mean, again, we had that conference, in Paris, or in France a few weeks ago. And again, all the big heavyweights from Wall Street, global Wall Street were there. And it just said, basically, we're open for business. And, a lot of the big financial firms have moved some jobs out of London into Paris, in addition to other European capitals. But you just think about the taxes and some of the social programs and things like that. Is it really open for business? And can they attract significant foreign global investment into that country? So,
or is it like more open it's going to be versus other countries, right? Like the cleanest shirt and the dirty laundry. But as Marcus was saying,
now everything's on hold until July 7th, and we get that vote.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One stock that's doing some stuff is Micron. We got some price targets raised. It's going to report earnings next week, and it is just having an awesome day and an awesome ride. Let's get a take here from Kim Forrest. She is founder and CIO of Bokeh Capital Partners. She joins us now. Hey, Kim, Micron, what do you think about it?
I absolutely love it, but maybe not at an entry point right now. It goes up and it goes down. This is a very volatile stock, but it's certainly one to keep your eye on. And you can ask me why. Why? I have two letters for you. AI.
Okay, but why? Like, tell me more. Tell me more.
Because of AI. This company makes the devices that build out data center memory, okay? Or, you know, where data lives. And if there's one thing I know about AI, it's that it eats data like you wouldn't believe. So if you believe in AI, you should believe in the makers of NAND and DRAM memory devices. So there you go. That's why I like it.
Hey, Kim, at a cocktail party, somebody comes up to you and says, how do I invest in AI? Where do you steer them?
Or you're at the wrong cocktail party, but
yes.
Go ahead.
Yes, actually, you know, I try to go incognito at cocktail parties, but that's okay. Well, I always say invest carefully and have a reasonable timeline. And I think those are the two things that people right now are probably forgetting by, I don't know, making NVIDIA go up by 30% since the split. Does that seem right to you? I'm thinking no, but whatever. So what you really have to look for is the chain of areas that AI touches. And again, one of them is NVIDIA, the chip that drives, you know, the models. And that's certainly important, but there's going to be a whole lot more infrastructure around it. And even things like, I know this could be a big eye roll, but telecom is probably going to have to markedly increase its capacity for wireless consumers, because we're going to be consuming a lot more data, storing a lot more data, and these models, as I say, use a ton of data. So anything in that chain is fair game right now for investing in AI.
We would never eye roll you for saying telecom. But based on the fact that you say, you know, Micron can be really volatile, you don't want to buy at these levels, you want to buy on dips, are you noticing a lack of dips? Are dips becoming less frequent at this point?
Yes, and I think it's because, you know, what are we, 36 months into discovering chat, or not even that long, 18 months into discovering Chat GPT, something like that. So people are really still looking for, how do I invest in that? You can't buy OpenAI, you can buy NVIDIA, but that feels a little stretched. So where else do you look? And I say, AMD is also fair for this, because they're going to not only be a competitor for NVIDIA, but also make some of the products that go on an end device. We keep forgetting, like, the user has to be able to connect to these models. And that's really important in your search for where the outsized growth may be.
So, Kim, what is NetApp, and why do you like it other than the fact that it's up 41% year to date?
Well, I mean, that's really helpful, right? but all joshing aside, you know, the nerdiest, I mean, it's almost like a math joke, right? Like a finance joke, but I digress. No, seriously, it's back to storage of data. Now, NetApp makes enterprise storage devices, and I think the enterprise is going to have to store a whole lot more data to make AI work for it. So that's why we really like NetApp. And just the trends in the world becoming more digitized, businesses need to have stable, safe, and reliable storage appliances, and that's what NetApp provides.
Mm-hmm. Kim, what else do you like aside from the AI trend? Like, if that's a nice trend, you got the momentum, you know, you got to find your levels, etc. Aside from that, if I wanted to buy stuff, where would it be?
Buy stuff in tech or not in tech?
No, outside of tech.
Outside of tech. Well, I'm kind of loving, because I like to buy low and sell high. I'm looking at energy, and I like ExxonMobil because it has, well, just bought some land in the Permian Basin through its recent acquisition, so that's good. And I'm somebody that believes in giving yourself some margin, some room for error. And we might like EV cars, but it's unclear that automobiles and trucks are going to go away immediately. So I think the timeline for energy is much longer. And the big energy companies are also investing heavily in alternative energy as well. So we're going to always need energy. We like our things that use it.
Yeah.
So I like to invest in that as well.
Yeah, and you have the gross yield 3.5%, so you're still getting something there. Kim, I'm wondering though, in energy, do you feel like you can own more than one stock? Because in talking to people on the street, it feels like part of the reason behind all the consolidation that's not fundamental is that portfolio managers just can't own a lot of them. So those companies need to make themselves very attractive for people like you to be like, I'm going to pull the trigger on this guy.
Right. No, I don't feel like I want to have a huge overweight to it. We run a sector neutral model for our flagship product. And what we do is we have one energy pick, because I like concentrated positions. So we enter a position around 3%. And that's why I always try to go for best in class. Because this is a commodity, you're not going to be able to catch the wave on buying low and selling high because, oil is doing whatever it's doing. So I just try to go for the very best company with the widest range of products. And that to me is Exxon, because it takes everything from getting it out of the ground into your truck, into your car, but also they do chemicals as well. So they have a very large product suite that addresses a lot of needs. That's why I like it.
Kim, how do you feel about just valuation kind of across the market here? I mean, a lot of folks are saying this market's rallied really hard over the last, call it 9, 12 months. We've seen good earnings growth, certainly, but has the earnings growth been good enough to kind of keep pace with where we are? So how do you think about valuation?
Well, I think the valuation, you can talk yourself into things being fairly or even a little bit below valuation if you believe, and this is a big if, the Fed is going to cut rates. And this is the math part of this segment here. Once we have lower rates, we get higher multiples. It's just how it works, because we discount those cash flows back at a lower interest rate, not a higher interest rate, and you have to accept higher multiples. And I think that's part of this game in this market right now is just about every last person, retail investor and institutional investors are all assuming the Fed's going to cut sooner rather than later.
When the Fed cuts, what then looks interesting in a way that it doesn't look now? Like, is that when small caps finally get some action?
I hope so. I love small caps, and I think you should be invested in small caps regardless of what the Fed is doing. It was awfully hard when the Fed was raising rates and being into small caps, but good things happen to small, highly high quality companies. And what I mean by that is they either grow into big companies because they have what it takes to satisfy customers and grow, or they get bought by larger companies. And both of those things are going to happen when rates decrease. That is, companies being more willing to buy, to acquire product lines or companies that they want to add to their portfolio, or just growth in general should start going once that rate cut happens. So all good things come from rate cuts, apparently.
All right, Kim, thank you so much for joining us. Kim Forrest, founder and chief investment officer, Bokeh Capital Partners, located in Pittsburgh. Kim Forrest, founder and chief investment officer there. So there's another investor loving the AI trade. And, I guess it's not just the chips. You can go software plays, whether it's Microsoft or somebody else. Some of
There's
the
still
hardware
a hardware
plays.
Exactly.
We've seen some hardware companies call it out. So
like the
thing,
telecom angle that you had. I heard that
I
one
had
before.
not heard that. Now,
There's
the energy angle,
yeah.
which we have the energy angle on utilities and some of the
and
other
the power
things. So
trade.
it just seems like you can bend this thing any way you like to support where you are.
And I feel like the theory is that, at some point we'll come back down to earth, but then you have Julian Emmanuel upgrading his forecast to 6,000, being like, the AI trade, it's too sticky.
Yep.
And that I feel like you're finally seeing that analyst capitulation at the end of the day to the broader market angle.
Yep, absolutely. And we look at the markets today. For Lisa Bromwich listening, who hates this term, unched on the S&P 500. Nothing happening there. The Dow's off 59 points. The NASDAQ's off 1 point. Not a lot of happening out there on the equity front, but that's okay.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We're just talking about AI. Let's segue, as Tom Keene would say, right to some more AI discussion. Mark Bergen, he is a technology reporter for Bloomberg News, joining us from Zoom from London, which is a technology hub, we all know. Mark, thanks so much for joining us here. Google, AI, what's their strategy?
Thanks for having me. I think, the good way to put their strategy in some ways is they're trying to no longer be in their back foot, right? I think that with the past 2 years, and our story this morning looks at how Google and DeepMind really set the infrastructure and then the base layer for this sort of AI boom that we've had, and then ChatGPT kind of took all the glory in some ways. And so they're playing catch up in, you'd say, not necessarily on the technical side, but there's certainly now, ChatGPT and all its iterations from the different companies building language models like Anthropic and Cohere, they're all sort of threatening Google's search in a way that really hasn't happened in almost 2 decades. And so their strategy is, I would say, defensive at this point.
How does it get on the offense? What does it need to do to sort of change that narrative?
Yeah, I think, the story we looked at today was a lot about this mergers that Google put in place a year ago. So they've had out here in London is DeepMind, which is widely considered like the world's leading AI lab, and has for the past decade effectively been the best funded university running in the world. Right? They've basically been a research lab. They put out some great breakthroughs like AlphaGo, AlphaFold around protein folding, but they're not. And they haven't been deeply integrated and connected with kind of Google's commercial and profit center. Google Brain, which was the competing AI lab that they also had in California, that was a little bit more tied to a lot of the popular Google services. And they've been all merged that for the past year under Demis Hassabis here, who runs all of Google AI. It's had kind of a bumpy road so far, but I think their plan is to continue to ship things like Gemini, their big foundational model, tweak that, and start kind of integrating a lot of this research directly into commercial services.
Mark, what does Google say about that ChatGPT and just as a fundamental threat to the core Google search business? How do they respond to that?
Yeah, I mean, Google publicly is great about never just talking about their rivals by name. I've said in many ways they say nothing. I think that that's something they've talked about for a long time, is that sort of their token phrase that Sundar Pichai uses is that search is the last kind of biggest moonshot for Google. I think they're thinking a lot about what that search interface looks like, how they're going to adapt to if consumers move to things like ChatGPT and Gemini. What does that mean for, say, Google's search ads business, which is still the lion's share of its revenue? They've had some clear mishaps, some pretty ugly snafus, and since the launch of Gemini earlier this year, right? Like there was that kind of famous incident where they were some of the responses were encouraging people to put glue on pizza, right? There were these. They described this as sort of like this is kind of early stage in this technology and some stumbles that they've had, but they are the world's leaders in search, and this is something where they have a lot of deep responsibility to get this right, not just for their business, but for people's trust in using Google.
Well, that's what's so difficult, right? It's like all the technology is changing so fast, but you still need to do it. So it's you're like, we're watching it in real time. Paul and I were just talking about a Washington Post article that was on the weekend that talked about how all the AI models cannot answer who won the presidential election in the U.S. in 2020. And I'm just wondering, how these advanced technologies solve for problems that they're using these large language models, which is basically me and Paul talking or regular people talking. Does that also mess them up?
Yeah, I think, it reminds me a little bit of, it's a slightly different technology, obviously, but, there in 2016, Google had this big mess where if there was a popular, or there was a blog, or this kind of fringe blog that said that, if I remember this correctly, it's been a long time, but it was that Hillary Clinton won the election in 2016, right? And that was at the top of, for briefly and momentarily at the top of Google News results. And they've dealt with this sort of problem around misinformation, around totally not credible sources being at the top of Google search. You're seeing problems they're now dealing with. I saw a story today about Google Images and like consensual porn. I mean, these problems I think are being multiplied because with these tools that generative AI do, which Google talks a lot of as being revolutionary, it also just makes content production so much easier. And so there's just this multitude of content now, and Google has been this sort of their primary service is to organize this, and that has a lot of messy problems, especially when OpenAI has kind of forced, and Microsoft has forced Google is to move a lot faster than they have been in years past, and we've seen some clear stumbles from that.
So, Mark, does Google feel like they can just solve this problem or make up ground simply by spending more? Because certainly they have plenty of cash to spend.
I think that's right. I think, I would say they have the CapEx to be able to do that. I mean, so does Microsoft. Yep. I think, Google's logic here is twofold, right? They clearly have a lot of engineering talent and a lot of experience on this, right? Like they're like I said earlier, that they have to launch this paper. They wrote this paper that launched this entire generative AI boom. They have decades of experience of actually like doing cutting edge AI. And I think they also have proprietary data that a lot of companies don't have, right? Like they have not just the main services, Google Maps, YouTube, search, Gmail, right? Just like that corpus of data they have that's able to sort of train AI services. That's something that really no other company has. I think the question has always been for them, can they translate that into something like for their cloud business, right? Where they're in third place now. Does that data set advantages, does that translate into commercial sales? Not necessarily clear, but I think that's sort of what they always point to is we have the talent and we have this sort of this infrastructure in place that's been there for decades.
Well, it's a really good piece. You guys should all check it out. It was in Bloomberg Business Week today. What are you working on next now?
Well, it's summer here in Europe, so nothing. No, I'm just kidding.
Don't let the bosses hear you say that.
I'll tease a story for tomorrow. I think there's, one thing that we mentioned briefly in this story. There's, I think it's really interesting is a lot of applications in AI are moving not just from kind of generating images and text and chatbots, but into the material sciences. That's something that DeepMind is working on a lot. I think there's a tension we talk about in the story today between, whether or not the company should be, how much time it allocates to working on Gemini and competing with OpenAI versus working on something that would kind of push the envelope and work in the biology or pharmaceutical industry. And DeepMind and Google shifted more research towards the sort of OpenAI competition. I think that's created this wave for a lot of new companies moving into biology and chemistry and applying AI to the lab. I think that's really interesting. Yeah,
I think we saw that in cancer research too. Like you're basically going to be co-pilots. So you still need doctors, you still need all the researchers, but they can be co-pilots. And that idea of thinking about that was quite interesting. Hey, Mark, really appreciate it. Look forward to tomorrow's article as well. Mark Bergen, a Bloomberg Technology Reporter, joining us from the UK. I don't know. I still don't get it.
I mean, just ask a person what practical application of AI, and I don't get a nice, consistent.
It's just, that's a cool thing about it all developing at once, but it doesn't make it easier for people like laymen like us to understand.
You just roll back 3, 4, 5 years ago, I think this was big data. We called it big data. And to me, this is just the next iteration of making smarter analysis of all the data, structured data and unstructured data. You think the internet, all that unstructured data, chats, all those types of emails and all that kind of stuff. And what is that data? How can you use that data to become more efficient? I don't know. That's a long way of answering. If you can't do it in like 20 words or less, you don't understand it.
Right.
And I'm in that camp.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies in 130 industries worldwide. I also get to bring in some of my oil CEOs, and I get to, I'll explain to Paul, like oil stuff, which I always appreciate. And joining us in studio, I have a very special guest for us. It's President and CEO of Weatherford, Girish Saligram. Weatherford is an oil services company. It does international, it does domestic, it does onshore, it does offshore. It also has a leg in the energy transition. What makes this company unique is that it went bankrupt in 2019. Girish took over in 2020, and the stock has crushed. This year, it's up by over the last year, it's up 90%. It's beaten all of its peers. It's beaten the oil services index. And even one analyst over at Citi said that the turnaround at Weatherford post-pandemic has been nothing short of remarkable. And these analysts don't hand out that kind of compliment very often. Girish, it's so good to see you. Thank you for stopping by.
Alix, great to see you again. And Paul, is great to meet you. Thank you so much for having me.
So how's it going? It's been quite a 4 years for you. Mm-hmm. You came in the bankruptcy, you had to turn it around. Where are you in this turnaround? What more do you think you still have to go, etc.?
No, great question. Look, it's been a terrific 4 years. The team's done an incredible job. I think very few people could have dreamt where we would be today and what was possible. The way I think about it is the turnaround's mostly done. We've gotten the company out of the ditch. We have stabilized everything. We have fixed the balance sheet. So the journey so far has been from broken to good. The next phase of the journey is really the good to great journey, and that's what I'm actually very excited about, because if we've been able to do all of the things that we've done over the past 4 years with a lot of constraints, a lot of shackles, the exciting part is what we can do without that.
So when you go from good to great, does that mean like a lot of buybacks and dividends? Does that mean, what is that?
Look, it's a lot of different things, but ultimately it is creation of value. And it's creation of value for our customers, for our employees, and most of all for our shareholders. But it's doing that with continued focus on greater cash generation, which comes from better margins, better improvement in the way we manage our net working capital, but also ultimately better investment. So our real goal is to make sure that we've got world-class return on invested capital.
Now that I see, as an outsider to the energy industry, I see a lot of M&A activity there. And being a former banker myself, that's what hits my radar screen. How do you guys think about M&A for your business now that you are on maybe firmer footing?
Correct. For the first 3 years, M&A was a bad word. Weatherford actually built up on a series of acquisitions and a lot of issues with that, especially around the lack of integration. So the first 3 years that I've been in the role, we really focused on the organic capabilities of the company, building out the portfolio, making sure we fix the operating intensity and the rigor around the company. But we have now gotten to a point where M&A has become a very important salient topic. We actually just exercised that muscle for the first time. We announced 3 small acquisitions back in February. So 2 in the wireline technology space, 1 in a very exciting space in intervention, which really gives us capability in slot recovery and plug-in abandonment, which is a very key part of that energy transition. So we have started to do that, and I think there will be more to come because we've now got a balance sheet that allows us to do that, and more importantly, a team that understands the importance of integration and is learning how to build that into the operating cadence of the company.
And just to give our listeners a sense, your services are the life cycle. How do your services differ than, say, one of your competitors? And how do you sort of invest for the life cycle of a well for a customer?
Sure. So in oilfield services, there's a lot of companies that do a lot of things similarly. So we've got what differentiates us, we've got a portfolio that provides core OFS services. So everything from drilling services to wireline, etc. But we're also able to complement that with what we call specialty services, things like managed pressure drilling, tubular running services, intervention services, etc., that very few, if anyone, has. So that combination of broad-based services that allow us to go toe-to-toe with the larger peers in the sector, as well as then these specialty products and specialty services give us that differentiation and also allow us to have higher margins.
I keep joking to Alix, with oil at $80 a barrel, I'm going to drive down to Texas and start drilling some holes. I mean, isn't the cost like $40 and $80? I can make some money there, but I don't see a whole lot of drilling activity. What's going to take it for the industry to take advantage of these prices here?
Look, I think the industry has really embraced this concept of delivering returns for shareholders. And so I think there's a lot of discipline, especially around managing capital within the industry. That's further exacerbated by the wave of M&A that's happening, which again goes back to driving higher returns. So I don't think in the US there's going to be necessarily a sea change at the range of oil prices that we are seeing right now, which I think in the longer term is actually good for our sector especially. It creates a balance versus the seesaw effect that you see in the cyclicality that we've seen in the past. We also have a very robust international market. So for Weatherford, less than 20% of our revenues come from North America. The bulk of it is really an international orientation, international leverage. So, we see a very healthy market. Now, the US is still the largest market in the world. We see a lot of activity, but it is something that is driven by capital discipline by our customers, which is a good thing.
And when we have M&A too, does that eventually lead into less business for oil services companies? Because in theory, maybe an Exxon Pioneer going to drill 10 wells rather than 20.
Yeah, I think, look, we are seeing a lot of drilling efficiencies. We are seeing the rig count go down. But I think it all comes down to differentiation. As long as companies can differentiate and deliver value to allow our customers to make greater headway on their efficiencies to generate higher returns, I think there'll always be business. Again, it is the largest market still.
I mean, I'm looking at your income statement. I mean, roughly half your revenue, Eastern Hemisphere, half Western Hemisphere. Give us the economics of both of those, your domestic markets versus your international markets.
Yeah, historically, North America was a very profitably challenged market for us on a profitability basis.
That's a nice way of saying that.
Right. So our team's done a fabulous job over the past few years, really changing the way we run the North America business. So today, the profitability across all of our geographies, all of our regions is pretty much in balance. So, and I think, I've always said the litmus test of our turnaround has been what's happened in the North America market. Over the past year, we've seen revenues decline in North America, but the profitability has actually gone up. So that's a real testament to what we've been able to do at Weatherford and the operating rigor, the operating intensity that the team has put in.
What are you doing on the energy transition space? Where do you play in that?
Yeah, so first of all, Alex, for us, it starts with this whole space of plug-in abandonment. We think that's going to be...
What does that actually mean?
Yeah, so what that is the responsible decommissioning of mature oil and gas wells. So as oil and gas fields stop producing, customers want to make sure that those wells are plugged properly so that you don't have any risk of leaks from them and you don't have any environmental damage. So we play a big role in that, and we have bolstered our portfolio with the acquisition that I just talked about earlier this year. So that's a huge space, and we think that'll be something that'll play out over several years. So, that's number one. The second element for us is geothermal energy. We've been a leader in geothermal for over 2 decades, mostly driven by our capability in high temperature tools. We've had a capability leading to very high differentiation in high temperature, which, as you can imagine, is important in geothermal. But we're now extending that beyond just drilling. So multiple aspects of the geothermal loop. We've got partnerships with organizations like Serafi, with Ever, which is a Canadian company doing some very novel work in geothermal. As geothermal shifts from this whole notion of you've got to be somewhere near a volcanic region to now in multiple parts of the world, in cities as well. I was in Hamburg about a year ago, where they're drilling wells in the middle of the city itself, providing district heating, etc. So geothermal's a big platform for us. The next one is CCUS. Now, CCUS is a huge ecosystem.
Carbon capture, utilization, and storage.
Nice.
Yeah.
It's a huge ecosystem. We don't play in a lot of it, but where we do play is in the storage and monitoring aspect of it. So again, this is where our technological capabilities lend themselves more directly. So that's a huge space for us. Sort of leading to that or away from that, but somewhat tied, is whole emissions management and emissions monitoring. We recently just announced a agreement, an MOU that we signed with Honeywell in this whole methane emissions management, which brings Honeywell's state-of-the-art technological capability, especially around sensing, our access to our customers' oil fields. We are also the only OFS player to have its own SCADA system, a data acquisition system, built on top of our production optimization platform. So that's an area that I'm very excited about. And last but not least, solutions mining. So that's a big area for us.
Girish, we really appreciate it. Thank you so much for stopping by. It's so good to get your perspective, and it's good to start getting chatting again and all the opportunities there. And like I said, Weatherford really outperforming all of its peers in the last year. Girish Saligram, President and CEO of Weatherford International.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele here with Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the news in business and economics through our lens of our Bloomberg Intelligence analysts. We also, every Monday at this time, tap Bloomberg NEF. Their research covers commodities, power, transport, industry, buildings, ag sectors, technology, anything that we need to know as we kind of transition our energy and security and energy transition throughout the world. And I should point out that every time they release their EV global outlook, it is the thing that is quoted by Wall Street analysts. You go to Wall Street analysts and they're using BNEF's data from EVs to model their own opinion. So we wanted to dig a little deeper. The report was released last week. Corey Cantor is BNEF lead U.S. electric vehicle analyst. Corey, thank you for joining. What was your overall takeaway? Like, okay, EV growth will be X. And then what was it for the U.S.?
Yeah, no, thanks for having me, Alex. Great to be back here with you and Paul. I think the big takeaway is that EV sales growth is happening unevenly across different regions in the world. Maybe not a surprising finding if you're following EVs on a day-to-day basis, but moving forward, we expect that to be a bit of the same. To give you a sense of where we see things going, we basically have both a near-term outlook and a long-term outlook. The near-term outlook ends in 2027, and so what we expect is by 2027, global passenger EV sales will be about 30 million in our base case called the economic transition scenario. And a probably better metric of that is thinking about EV share of passenger vehicle sale. So we'll move from a world where 1 in 5 cars sold is electric to a world where 1 in 3 is, about 33%, up from 18% last year. By 2040, we expect that about 73% of all new car sales will be electric, but there's a long way to go. And then on the US question, always good to compare it, I think, to China and Europe. US passenger EV share of sale last year was around 10%. We expect the next 2 years to see a bit of a slower growth. So only about 12% of new car sales should be electric this year, rising to about 29% by 2027. Seems pretty good, but if you look at Europe and China, it's going to be much higher there. So by 2027, we expect about 60% of new car sales to be electric in China and 41% in Europe. And when we talk about passenger EVs at BNEF, that's both battery electric and plug-in hybrid electric vehicles.
So talk to us about those plug-in hybrids. It feels like a lot of folks are suggesting that might be a very viable interim step, for at least in the U.S., in terms of the transition to EV. Is that how you think about it?
Paul, really good question. I also co-wrote the plug-in hybrid section of the report. We do a kind of deep dive, which we do a few different deep dives every year in what we call thematic highlights. I think around PHEVs, the question really is...
PHEVs?
Yeah, PHEV.
Plug-in hybrids, okay.
Plug-in hybrids,
okay.
Is how good are they going to be? If you look at the plug-in hybrids in China, they're all electric mode, meaning their kind of electric mileage they get before they have to turn on that gas engine is about twice as high in China currently as it is in the US. So quite simply, China is making not only better fully electric vehicles, but better plug-in hybrids. We still think that there is some role for PHEVs to play this decade in markets like the US, in Japan. But what I've been big on pushing on is the product that we're getting today is not necessarily as good as it should be. So when you hear automakers say, oh, well, maybe we'll do more hybrids or do more plug-in hybrids instead of fully electric vehicles, I think a fair response would be to say, well, in Europe and China, they're getting far more all-electric mileage than here. So can you deliver some of that more high-quality product? Ultimately, we do a bunch of different scenario analysis in the full report. And one downside of plug-in hybrids is that if you go down that route and people aren't charging them enough, which is harder to do because of the lower all-electric range, you could end up in a scenario where you're having a lot higher oil demand use than if you just switch to fully electric vehicles, and that would not be good for your climate targets.
When do you think the tipping point is when EVs become more of mass adoption here in the U.S.?
So what we've pointed out historically is this idea of upfront price parity. We're seeing total cost of ownership parity, including fueling, already being hit in many different regions. In terms of upfront costs, it really depends if you're comparing apples to apples, right? You see a lot more EVs in that kind of low $40,000 price range now, high 30s. I think once you get to the low $30,000 price point, really, according to our analysis, when you're looking at kind of a generic BEV versus a generic ICE vehicle, we see it happening in the US over, let's say, the next 3 to 4 years, really 2026 to 2028. But really, if you're comparing a Tesla Model Y towards a lot of its competitor vehicles or Model 3, you're getting pretty close. But that's where you start to see, I think, higher adoption, where you won't have to necessarily have a premium in price. You also get a lot of good leasing deals today on EVs, but it's a bit messier to kind of figure that out because you've got dealer markups, you've got different rates. But big picture, that upfront price parity.
How about the charging infrastructure in the United States? To what extent has that been holding back the adoption of EVs here, and kind of how do we expect that to evolve?
Yeah, I think that's the biggest difference between Europe and China. Our EV outlook, for folks who aren't familiar, has whole sections on charging infrastructure, how much investment is going to be needed moving forward. But really just taking a base level stat, Tesla remains the #1 provider of charging infrastructure here in the US in terms of reliability, in terms of number of fast charging stations. And then there isn't really a clear-cut number 2, 3, 4, 5. My colleague Ryan Fisher does a bunch of great presentations on this. And one of the most impressive findings is US and Europe actually have a similar amount of chargers between the top 6 kind of charging infrastructure operators, but Europe has an additional 500 operators after that really supply the bulk of the market. So again, we want to see more of that infrastructure built out. There's been a lot of reporting around the federal funds rolling out really slowly because they've had to go through state RFPs. But yeah, that's the #1 issue holding back probably the US market, maybe even moving past the upfront cost issue.
Oh, we only have about a minute left, but at least with my ICE car, right, I can trade it in. And I can get value for it. Do we know how this market evolves for EVs?
Yeah, I mean, I did a residual value note with the team at BNEF maybe about 2 years ago, and the market looked so different then. That's when Tesla prices were going 10 to 15% above their kind of selling price. And so now you've seen, because Tesla brought its prices down, that residuals for a lot of EVs have crashed. I think it's going to be something that continues to develop. We need to find out how long batteries are going to last.
Right, do we know that yet?
It varies. I mean, we don't have, I think, any research here where we've said that this is what we find amongst all the kind of EVs in the market. But right, if your battery holds up longer than people expect, you'd expect to see maybe more residual value. If not, you could see more of an issue. But yeah, it's an outstanding question, like so much of the space. But to your point, Alex, that's why you want to see more, look into battery life over time.
Yeah, exactly. I think that's going to be really interesting. All right, Corey, thanks a lot. We really appreciate it. Corey Cantor, BNEF lead U.S. electric vehicle analyst, joining us on their new report. Definitely check it out. It's what all the street winds up quoting as we sort of go through this energy transition with the questions that we all have. I don't know, how long have you had your phone? I'm comparing battery life.
Just I got 5 years maybe.
5 years? Okay, so let's just say 5 years. Yep. I'm assuming a car battery is going to be a lot better than your phone battery?
I hope so. I don't know.
But I don't know if you're forced to re-up your car because of the battery. I don't know. That feels different. That feels different than I just got to replace my brakes. I don't know.
Walk into the Apple store.
Maybe I'm wrong. Yeah, exactly. All right, this is Bloomberg Intelligence. Happy Monday, everybody.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.